Exercise 711 is going to take us a little bit of time because it asks us to do the first 2 years worth of depreciation under each of the 3 methods. Well, we'll start with the straight line method. It's kind of the easiest, it's the most straightforward, and it is the most common. So we're going to take the purchase price minus the expected salvage value at the end, $6,400, and that gives us $29,600. So that's the total amount of depreciation we're going to take over the entire life of the asset. If we divide that by 4 years, so we're going to take the $29,600, divide that by 4, we come up with $7,400 per year. So that's our depreciation expense year 1, year 2, year 3, year 4, until it's done, and that would finish it up. That's the straight line method. All years, same amount. Okay. The next method it asks us to do is the double declining balance method. I made my papers cockeyed here. There we go. Now, this is going to take, this asset's going to last us 4 years. So each year, 4 years, we'll be using it 1 year for each of those 4 years. So a quarter, we'll use up a quarter each year. That's 25.25, which equals 25%. So our depreciation rate under the double declining balance method will be 25% times 2, or 50%. So the first year, our depreciation is 50%. That's our rate, 50%, because it's always going to be that 25 times 2. So our depreciation expense will be $18,000. Our accumulated depreciation at the end of year 1 is $18,000. We've only taken depreciation for this year. The book value is the beginning value minus accumulated depreciation, which in this case is $18,000. Now, the declining part of the double declining balance refers to the beginning book value, $18,000. We're still going to take 50% of that, but now for year 2, our depreciation expense is $9,000, and our accumulated depreciation is the 9 from this year plus the 18 from last year, $27,000, and our book value is 36 minus accumulated depreciation of 27, $9,000. So that's the accumulated depreciation minus the book from the book value gives you the ending book value. Beginning book value minus accumulated depreciation, ending book value. Depreciation rate is the life in years turned into a fraction multiplied by whatever the accelerator is. In this case, it's double. It could be triple. It could be 1.5. It all works exactly the same. The last method they asked us to use is to do activity-based, and here we need a few more pieces of information, plus we need to figure out what we're going to do. And they tell us, let's see, they give us some more information. I'll jot it down in here so we know what we're talking about. They expected, well, first of all, we need the 36,000 minus the 6,400, because that doesn't change. So that's 29,600. That's the total depreciation we expect to take. During the 4-year period, the company expects to drive the van 148,000 miles. So if it's going to cost us $29,600 in total depreciation, and we're going to get 148,000 miles out of that, that means roughly that each mile cost us 20 cents. Each mile cost 20 cents. About. More or less. Approximately. Could we have a flat tire and spend more 1 mile? Yeah. But overall, that's what it's going to be. So they tell us in the first year, we use 40,000 miles. Our depreciation rate is 20 cents. So 20 cents times 40,000 miles, our depreciation expense is 8,000. Our accumulated depreciation is 8,000. And our book value, by definition, is always purchase price, 36,000, minus accumulated depreciation of 8,000. That gives us our book value, year 1, 28,000. That's how we got that. Now, year 2, it tells us we used it a little bit more in year 2. We drove 46,000 miles in year 2. Each one of those still cost us 20 cents. So that's 46,000 times 20 cents. That's 9,200. Our accumulated depreciation is this year's depreciation expense plus what we had last year. These two added together gives us our current depreciation, accumulated depreciation, 17,200. To figure out what our book value is, we take our 36,000 that we paid for it, minus our accumulated depreciation, 17,200, and our book value at this point is 18,800. And at the end of year 2, that's our book value. All three methods, things you have to remember. With this method, you have to remember to do this multiplication. Students will often forget to do that, and you come up with some goofy number like your depreciation expense for the year is 20%. In declining balance method, the thing that students often forget to do is they first forget how to convert this fraction to a straight line rate and then to increase it, and then to make sure that you do not consider the salvage value. You look at the entire amount, and with the declining balance method, you stop when you get to the salvage value. And the straight line method, there's not a whole lot to remember. You simply have to remember that with the straight line method, you do deduct the salvage value. As a matter of fact, you do that for all methods except the double declining balance method.